Index funds versus picking stocks, the honest answer for beginners. Over a 20-year period, 93% of professional fund managers, people with finance degrees, Bloomberg terminals, and six-figure salaries, failed to beat the S&P 500 index. 93%. These are the so-called experts, and somehow you're on Reddit at 1 a.m. thinking you're going to outsmart them by picking individual stocks with your $200 Robinhood account. Let's talk about that. I'm not here to tell you what to do with your money. I am here to show you what the math actually says, because the financial industry has a real incentive to make this stuff feel complicated. Complicated means you pay someone. Simple means you keep more of your money. Let's get into it. Chapter 1. What even is an index fund? Before we compare anything, let's make sure we're speaking the same language. An index fund is a single investment that holds a basket of stocks designed to match a specific market index. The most common one tracks the S&P 500, which is basically the 500 largest publicly traded companies in the United States. Apple, Microsoft, Amazon, Johnson & Johnson, they're all in there. When you buy one share of an S&P 500 index fund, you're buying a tiny sliver of all 500 of those companies at once. You don't have to research any of them. You don't have to decide which one is going to pop off next quarter. You just buy the whole market and move on with your life. The two most popular ones are VOO from Vanguard and FXAIX from Fidelity. VOO has an expense ratio of 0.03%. That means for every $1,000 you invest, you pay 30 cents per year in fees. 30 cents. That's less than the cost of a single gumball. Compare that to an actively managed mutual fund, which charges an average of 0.44% or more, and still probably loses to the index anyway. The math is not subtle here. Chapter 2. What stock picking actually looks like for beginners. Now let's talk about the other side. Stock picking means you choose individual companies to invest in. You buy shares of Tesla or Nvidia or whatever ticker symbol your coworker whispered to you in the break room. Here's what nobody tells beginners about stock picking. It's not just about finding good companies. It's about finding companies that are priced lower than they should be before the rest of the market figures it out. That's a completely different skill. Coca-Cola is a great company. That doesn't mean its stock is a great buy at any given price. To pick stocks well, you need to understand earnings reports, price-to-earnings ratios, debt levels, competitive moats, sector trends, and macroeconomic conditions. Or you need to get lucky, and luck runs out. I've seen this happen more times than I can count. Someone opens a brokerage account, buys 3 or 4 stocks that are trending on social media, watches them go up 15% in a month, and thinks they've figured out the market. Then a correction hits, and they lose 30% in 2 weeks. They panic sell. They swear off investing entirely, and they're worse off than if they'd done nothing at all. That's not a hypothetical. I watched a friend do exactly this in 2021 with meme stocks. He put in $3,000, wrote it up to about $4,500, then watched it crater to $100. He sold and hasn't invested a dollar since. The S&P 500 is up roughly 25% since then. His money is sitting in a checking account earning 0.1%. Chapter 3. The numbers don't lie, but Wall Street does. Let's look at actual long-term performance. From 1993 to 2023, the S&P 500 returned an average of about 10.2% per year. If you had invested $200 a month into an S&P 500 index fund starting in 2003, by 2023, you'd have put in $48,000 of your own money. Your account would be worth roughly $132,000. You more than doubled your money by doing literally nothing except setting up an automatic transfer. Now compare that to the average individual stock picker. According to a study by JP Morgan, from 1980 to 2020, 44% of all stocks in the Russell 3000 experienced a catastrophic loss, meaning they dropped 70% or more from their peak and never recovered. Almost half. So if you're picking individual stocks, you've got close to a coin flip chance of picking one that eventually goes to near zero. The financial industry doesn't love index funds because there's almost no money in them for the industry. Nobody's earning a fat commission selling you a fund with a 0.03% expense ratio. That's why you'll see ads for trading platforms, stock picking newsletters, and premium research tools everywhere. They need you to believe that active trading is the path. It's not that those tools are scams, some are fine. It's that the entire business model depends on you staying busy with your money instead of leaving it alone. Chapter 4. When stock picking actually makes sense. I'm not going to sit here and pretend index funds are perfect in every situation. There are legitimate reasons someone might pick individual stocks, but most of those reasons don't apply to beginners, and especially not to people starting with limited cash. Stock picking can make sense if you have a large, diversified portfolio and you want to allocate maybe 5 to 10% to individual bets. It can make sense if you genuinely enjoy financial analysis and treat it like a serious hobby, not a get-rich-quick scheme. It can make sense if you have a long time horizon and the emotional discipline to hold through a 40% drawdown without flinching. But here's the thing. If you're watching this video, you're probably not in any of those categories yet. And that's fine. You don't need to be. You need to build a base first. Think of index funds as the foundation of a house. Nobody puts up crown molding before they pour the concrete. Stock picking is crown molding. It's a nice addition once the structure is solid. The honest rule of thumb: don't pick individual stocks until you have at least $10,000 invested in broad index funds first. That gives you a real foundation. After that, if you want to take 5 to 10% of your portfolio and buy individual companies you believe in, go for it. But the base stays boring. Boring is what builds wealth when you're starting from zero. Chapter 5. The real enemy isn't picking the wrong strategy. Here's something that gets lost in the index fund versus stock picking debate. The biggest risk for most beginners isn't choosing the wrong investment. It's not investing at all. According to the Federal Reserve's 2022 survey of consumer finances, roughly 42% of American families own zero stocks. Not directly, not through retirement accounts, nothing. Zero exposure to the market. Meanwhile, the S&P 500 has returned over 3,000% since 1980. The cost of sitting on the sidelines is enormous, and it compounds every single year. People get so caught up in optimizing: should I buy VOO or VTI? Should I wait for a dip? Should I pick stocks instead? That they end up doing nothing for months or years. Analysis paralysis is more expensive than any bad stock pick. A person who invests $100 a month into a mediocre fund will almost always end up richer than a person who spends 2 years researching the perfect portfolio and never starts. So if you're sitting there with $50 or $100 and you're not sure what to do, the answer is painfully simple. Open a brokerage account. Fidelity and Schwab both have no minimums and no account fees. And buy shares of a total market or S&P 500 index fund. Set up an automatic monthly transfer, even if it's just $25. Then close the app and go live your life. That's it. That's the whole strategy for year 1. Chapter 6. The one move to make this week. I want to leave you with something concrete, not just theory. Here's what I want you to do in the next 7 days. If you don't have a brokerage account, open one. Fidelity, Schwab, or Vanguard. It takes about 15 minutes.
If you already have one, set up an automatic recurring investment of whatever you can afford, $25, $50, $100, into an S&P 500 index fund or a total stock market index fund. The ticker symbols to look for are VOO, FXAI, SWTX, or VTI. Pick one. It honestly doesn't matter much which one. They all do roughly the same thing. Then I want you to do something that might feel weird. I want you to screenshot your account balance. Yes, even if it's $25, and save it somewhere you'll see it in a year. Put it in a folder on your phone called Proof I Started. Because a year from now, when that balance has grown and you've built the habit, that screenshot is going to matter to you more than any stock tip ever could. Don't come back to this video and tell me you liked it. Come back in 12 months and tell me what your balance is. That's the only metric that counts.